If you don't look at it, you are not an investor, you are a donor. They go into private credit and real operating businesses, logistics, manufacturing, agriculture, infrastructure, energy. A typical retail investor thinks like this: where can I jump in to make a 3x? They start from the simplest place: Bitcoin and Ethereum. Give me 15 TikTok shitcoins. Hi, this is Ivan Marchena, Chief Communication Officer at A-Lens. And today I would like to speak about a very important topic: your investments versus hedge funds. The difference no one talks about. Imagine you are entering crypto, not as a small trader messing around on Binance, but as a fund. You are not playing with 3,000, you are managing 30 millions. And your job isn't to hit a 10x. Your job is to not blow out capital and grow it so that 5 years later investors shake your hand. If I ask, how would you invest that money? You wouldn't say, I will put everything into one meme coin and pray, right? So we study how smart money invests: hedge funds, family offices, big crypto funds. Then we adapt the same logic for normal people. Those with 550,000, not with 50 millions. Now we'll show you the safest investment option in crypto and through crypto, and how to assemble a portfolio that same way big players do. No casino, no all-in-one coin, no DeFi black magic. Not financial advice, just common sense. Let's get into it. First, the idea without which nothing else makes sense. A typical retail investor thinks like this: where can I jump in to make a 3x? Smart money thinks differently. How do I protect capital and earn a reasonable return with controlled risk? Huge difference. A fund doesn't care about a favorite coin. It cares about risks. They split capital into these layers. The safest layer, almost like cash. A layer with risk, but understandable and manageable. And a small layer for venture and moonshoots, the icing, not the whole cake. And the main rule is simple. First, protect capital, then make money. Retail does the opposite. First, they are greedy, then they panic. Now, let me show you how these layers can exist in and around crypto, even if you are not a fund, just a normal person. Let's start with the basics. When a big player enters crypto, they almost never begin with "give me 15 TikTok shitcoins." They start from the simplest place: Bitcoin and Ethereum. Not because they are some sacred things, but because they are a bet on the industry itself. If crypto survives as an asset class, these assets are the most likely to survive first. What does a fund do? It doesn't try to perfectly catch the bottom, it averages, breaks the entry into a stage. It has a clear thought: I want to build, for example, 30-40% exposure via BTC ETH over the next few years. And it calmly builds that position. What does that mean for you? That the base of a crypto portfolio is not 20 altcoins somebody recompensed in a Telegram chat. It's 1 to 3 major assets, no leverage, no futures, with a reasonable time horizon. Then funds add simple yield to that base. For example, with Ethereum, staking or liquid staking. Not 10 protocols offering 50% APY, but 1 or 2 proven platforms with understandable risk. You're basically earning a coupon for helping the network operate. And there is another tool funds actively use: tokenize traditional assets. That's when you basically buy a token backed by a treasury bond fund or a money market fund or some fixed income dollar yield. But you do it through a crypto without opening an American brokerage account or juggling a dozen different platforms. So you get this super basic foundation layer, BTC ETH, without leverage, a bit of staking, tokenized fixed income. This won't give you 100% APY, but it already looks like a real foundation, not a lottery ticket. Now, let's move to the second layer. This is where things get much more interesting. Real-world economy through Web3. Look at what funds and family office do when they want stable returns. They go into private credit and real operating businesses. Logistics, manufacturing, agriculture, infrastructure, energy. Why? Because these deals have three things: a real business that generates revenue, collateral, a real asset that can be taken if things go sideways, a legal framework, contract, security agreements, enforced procedures. Normally, the entry ticket here starts at 100 or 1,000 or millions. A regular person simply can't get in. And this is where Web3 becomes a very powerful bridge. Through tokenized structures, through crowd-lending, through platform where the deals looks like a Web3 product on the surface, but underneath it's a classic loan to a real business. So in the interface you see a pool, the yield, the duration, the collateral. And on the platform side, there are already legal contracts, reports, documentation on the collateral, informances processes. And this is exactly the space where we work with A-Lens. We are not trying to invent some magical DeFi yield. We're taking what funds have been doing for decades, lending to operating businesses secured by real assets and wrapping it into a Web3 format, where an investor can enter through crypto with no 100,000, but say $100-500 per deal. It's important to understand the difference. DeFi farming with 60% APY. You are basically playing a game of stake smart contracts, tokens, inflation, and incentive loops. If the system collapses, you are left holding a token nobody wants. Lending to a real business through Web3, your yield comes from someone else's revenue. You have collateral under you, and above you, lawyers and an enforcement process in case of default. The risks don't magically disappear, they just become normal. Human risks, credit, legal, business risks. Not, I lost everything because someone exploited the smart contract at line 20. The third layer is infrastructure and moderate DeFi. When people hear this word, DeFi, many immediately imagine something like, oh, that's the crazy stuff that gives 300% APY for 3 days. But smart money plays a different game. Money market protocols like Aave, Compound, and their institutional equivalents, large liquidity pools on major assets, infrastructure tokens, network, L2s, oracles, routers. The logic is simple. Capital should work but not lose its mind. A fund calmly allocate part of its capital into lending protocol, earns its 510% per year in stablecoins or major assets, monitors protocol risk, limits audits, and that's it. They are not chasing a new fund every week. They are building a blockchain version of banking. Liquidity is here, lending is here, liquidity provision is here, where the risk is clear. For a normal person, this means not all DeFi is a casino, but you also don't need all of DeFi. If you are not a fund, you don't need to scatter across 15 protocols. You need 12 well-established solutions where you understand the mechanics and you are comfortable signing off on the risks you are taking. Now, the 4-layer venture and early stage projects. This is what retail usually makes the core of their portfolio, while funds treat it like thin top layer. How do funds enter high-risk opportunity? Seed rounds, private rounds, token sales. Dozens of projects. 37-year horizon. Understanding that 1,020% will pop and the rest will either die or deliver modest returns. They have risk management, discipline, and a calm mind. This slide of capital may go to zero, and that's fine within our model. What does the average person do? Put 70% of their deposit into one promising project, reads 2 articles and 3 X tweets, and waits for this to be your ticket out of the rat race. The difference is one word: structure. So if you apply fund logic to a real portfolio, venture and aggressive crypto should be 5 to 10% of capital. If you are not good at losing money, 2 to 5%, but definitely not 80%. Now, the most important part, how to put everything together. Let me draw 3 examples models. These aren't some correct proportions, they are frameworks that help you think the right way. Model 1, conservative. For someone who's tired of volatility but doesn't want to leave crypto entirely, it could look like 60-70% foundation. BTC, ETH with no leverage and tokenized fixed income. Tokenized treasury, money market funds, etc. 20-30% real world economy through Web3. Crowdlending, RWA platform like A-Lens, where there's collaterals and a clear deal structure. 5-10% moderate DeFi, infrastructure, a solid lending protocol, liquidity on major pairs, something where you actually understand how it works. That's it. You won't brag about a portfolio like this in a Telegram chat, but 5 years later, you are far more likely to have capital, not another story about missing another huge bull run. Model 2, balanced. 40-50% foundation BTC, ETH, plus fixed income through crypto. 30-40% private credit, RWA crowdlending, A-Lens and similar platforms, up to 10-15% infrastructure and moderate DeFi, up to 5-10% venture, early stage tokens, high risk plays. This looks a lot like how many crypto funds operate. A bet on the industry, a bet on real cash flow, and a bit of spice on top. Model 3 for the crypto native crowd. For people who still want to play the space actively, but don't want to walk on the edge of a knife. 30% BTC, ETH. 30-40% fixed income via crypto. Tokenized treasuries, RWA credit, crowdlending. 20-30% high conviction alts, infrastructure plays, networks, L2s, up to 10% venture and aggressive bets. The point isn't the numbers, the point is the mindset. I allocate based on risk buckets, not favorite tickers. Now let's talk about where retails usually fail and why funds just smile and walk past those traps. Mistake number 1. All in one token or one exchange. Convenient until it hurts. One problem, and you don't just lose yield, you lose the entire position. Mistake number 2. Ignoring liquidity. Funds always ask, if we enter with this size, can we exit without destroying the market? Retail usually think last. I will give it a try and I'm sure it will pump on the next bull run. Then it turns out that you are stuck with the coin forever. Mistake number 3. No attention to paperwork or legal structure. In credit deals, RWA platforms like A-Lens, the legal framework is half the protection. If you don't look at it, you are not an investor, you are a donor. Mistake number 4. Confusing type of yields. Some yields is compensation for risk. Some yields is magic, APY that exists only while marketing and token emission continue to pump the system. Funds always know where every percentage point comes from. Retail often just sees a number on a dashboard and think, cool, I will take that. And let's be honest here, why am I explaining all of this in the context of A-Lens? Because we didn't build another DeFi shit project with high yields. Our goal is very specific. Take one proven layer of how professional funds operate private, collateral-backed credit, and make it accessible to someone who lives in crypto. We are not promising it's risk-free. We are very direct about the risk, credit risk, business risk, legal and enforcement risk. But there is a real business under the deal. There is collateral, there is a process, there is transparency. And that is fundamentally different from I put all my money into that token because a guy on X promised 100x. If everything we talk about could be put into one sentence, it's this. We took the smart money approach, layer risk, and scale it down to the size of a normal investor. You may not have 50 millions, you may have 5K, but the logic can be exactly the same. Part in the foundation, part in real world economy, part in infrastructure, a small slice for some lottery tickets. And an answer to one question, be honest here. Right now, are you investing like a fund or like a casino player who accidentally wandered into crypto? Because if you want to invest like a fund, you can start today by rebuilding your portfolio. Write down which risk buckets you actually have, where you are just holding stable coins that earn nothing, where you are taking risks and at least getting paid for it, and where you're pure gambling, which probably needs to shrink. Join our Telegram. That's where we break down how our business works, share guides, case studies, and real strategies for income backed by real companies. If you want to be not just someone who has crypto, but someone who manages capital, this is the point where your journey starts. Thanks for watching. See you in the next video.